January headline inflation is due to be released tomorrow, likely to hit the 12% threshold, according to analyst forecasts. If this is accurate, it will mean that inflation has increased for 5 consecutive months. This will be a major concern for policymakers. The Monetary Policy Committee at its last meeting emphasized the determination of the CBN to rein in inflation because of its negative impact on GDP growth and unemployment. Analysts also expect food and core inflation to rise respectively. All right, so joining me in the studio to discuss January inflation expectations as well as impact on the equities market is research analyst from Cardinal Stone, Mr. Jerry Nnebue. I got that right, yeah? Fantastic. Welcome to the show, Jerry.
Yeah,
all right, so I actually thought inflation was going to be out today, but Mr. Dr. Yemi Kale, statistician general, sent out a tweet saying they'll actually be coming out tomorrow at 8:30 a.m. So we'll all be up and early, ready to see that. How do you see it? Are you one of those analysts that think we're going to hit the 12% threshold, or how do you see where it is now?
Very possibly. I think it's likely we would hit 12%. I mean, our expectation is that it's going to come out at 12.07%. As of December, it was 11.98%. So I don't think there is any surprise. There will be any surprise in the markets, the uptrend in inflation, because everyone has expected it. We all know the story, that started last year from the border closures and, the food prices. And then what's expected to happen this year, hike in electricity tariffs, VAT hikes and all that. So yeah, the general expectation is that inflation will continue to rise.
It's been said that all these things you mentioned, VAT, tariffs, electricity tariffs, border closure and food prices, they're all punches. They're punching the little guy, the average Nigerian in the face. Are those the main factors that we're looking at as far as the increase is concerned? Nothing else outside of those?
Yeah, so I think those are very, very key. First and foremost, look at the food part of it. I mean, food has been a major constraint for Nigeria in terms of the CPI. And that started with, if you look back, a couple of years ago, the whole Fulani, the headers farmers clashes, you get the floods, that weaken harvests and all that. So we've had those issues with food inflation over time. Now, add to that border closures. You get add to the border closures, and then that's weakens whatever downside we're expected from inflation coming from food. So yes, food is a key ingredient. I think it's contributes about 50% to the CPI bucket, and that's one of the big upswings to the inflation expectations. On the other side, core inflation, we saw it weaken, moderate sometime towards the end of last year, the beginning of last year, up to mid 2019.
Yes.
However, with the whole talks about implementation of minimum wage hike, the whole talks about VAT hikes, which is already in effect, electricity tariff hike, all these have potential implications for core inflation, even down to what we're seeing in Lagos State alone.
Transportation.
Yes, transportation.
I was about to ask you about
that's a big one. So I mean, Lagos State is just a sub part of the country, and inflation estimates covers the entire country. But we know that Lagos is a very big market, and so that in itself, which was not there before, can have implications for prices.
And with the Lagos State governor saying that there's no going back, I mean, can this not be seen as a continued pressure, at least from from Lagos State?
It's a sustained risk, really. I mean, what we expect this year is that we'll probably see inflation get to as high as 13% probably by June of this year.
Wow.
And then maybe we'll begin to see some reversals, as structural measures come into place. Let's not forget that inflation dynamics in Nigeria is largely a structural play. I mean, if you look at food, what's really hampering food? We've seen moderation in the clashes between the headers and the farmers over time, so we expect improved harvest, and that in itself can support food prices. Domestic, farming itself, for most of those food that we typically import, because we've not been able to, for food and other products in Nigeria that we typically import through the borders and all that, once manufacturing activities begin to catalyze in those sub-segments, then we think that can support prices for food inflation. So these are actually structural issues that we think can be rectified over time.
Yeah, but we've been talking about these structural issues for quite a while.
Yeah, we have.
We have, and so it's an optimistic outlook, though. I do like that. What about the inflation targets? Inflation target is single digits. It's 9%, isn't it? I think it's 9%. Can we pretty much do away with that? Just take that and toss it to one side? Because if you're looking at 13%, I've heard almost every analyst I've spoken to right here on the Global Business Reports, Rise News, has said we're looking at coasting at double digits for the rest of the year. So forget single-digit inflation target, right?
I don't think there's anyone who bases an investment decision today on single-digit inflation for Nigeria, at least for the next 2 years. But for the CBN, that's probably like a target, so it helps them to formulate monetary policies over a longer period of time.
Yeah.
So yes, they actually need that target to be able to define monetary policies today. Over time, we expect that we're going to be here. But for us, as we make our investing decisions and policy, formulate strategies for businesses, of course, nobody's looking at 9% inflation target, really.
Gosh, we need to get to the bank. So this inflation thing is so interesting. Now, the thing is, if you maintain double-digit inflation through 2020, going into the end of the year, that, of course, doesn't have an impact on... Yeah, there we go. So we've got up there on our screen for our viewers, 11.98% is where we are for December. Yeah. The disposable income for the average Nigerian, they're going to, with inflation elevated at double digits, people are going to, they'll feel it in their pockets, will they not?
I don't think it's a surprise. We've been feeling it
for now.
So yes, so I think most people, yes, exactly. A lot of people have actually priced that into their daily lives. I'll use again this instance of what's going on in Lagos. Everyone is clamoring to bring back the Okodas and bring back the kekes because transportation is not really easy within the city. Right. Now the alternatives that are coming in, people would gladly pay double the amount they were paying before just to be able to get to their destinations. Nobody likes a trek. Right. So yes, and it's not a very favorable policy. But then again, people would just have to adjust to all of these things. It has its negative implications for disposable income because if I spend more on some of these items on transportation, then I have less to spend on other necessities.
Okay. Nobody likes to trek except people preparing for the Lagos Marathon. All right, but okay, real quick, let's move on to the banking. You're primarily a banking analyst, yeah? You check the banks. Equities markets, how have you been seeing that? I think the market was negative on Friday, yeah? How are you seeing things with regards to market activity?
Yeah, so I think what's going on in the market is not a surprise to us. It started on a roller coaster at the beginning of the year in January. We saw the market climb as high as 10%, one of the best performing in the world.
In the world, they were celebrating it.
So yes, everyone was celebrating. But the big question that should be asked is what changed between December and January structurally, because the market needs to be driven by core fundamentals. But what we noticed happened was that the market was largely driven by surplus of liquidity and a lot of speculation. Now we're beginning to see the actual trend, that the market is supposed to take. So yeah, weaknesses in the last 3 weeks, we've seen the market close negative 2.6, 2.7, and then down 1.1% last week. The banking stocks obviously have been, some of the big winners and losers, since the beginning of the year up until now. So we saw the banking stocks, most of them climbed really high, and they were also seeing them, a lot of profits taken in those tickers. And I think that's something that will probably continue. In the interim, we see that volatility. People buy, speculate on stocks up to a particular level and then begin to take profit. Yes. Because for a sustainable long-term growth in markets, we need to see some structural issues. We need to see some improvements in the macros. We need to see improvements in confidence and sentiments, for the overall markets outlook.
All right, just still have a teensy-weensy bit of time here. Just maybe touch on a couple of them. First Bank, for example, FBNH. I think the story there has been their oil and gas portfolio, yes? Is there still a narrative there?
Yes, so I think for First Bank, the story really is the fact that they've really gone through a long period of cleanup over time. Yes, so if you look at the last 3 to 4 years, First Bank has cleaned up over 650 billion in impairments. And from what management has disclosed last year, they've been able to do all that. So, from what they've said, they've cleaned up their books, so we expect some improvement. NPL has been really crazily high for First Bank, 25% down to about 12.6.
And just for our viewers, NPL, of course, is
non-performing loans.
Non-performing loans, cool.
So all right, bad loans. So 25% at the beginning of the year, down to about 12.6 as at half year. And then management has guided that it will bring it down to single digit, which is positive. The impairments, the cost of risk for the bank also was really very high, but then we're seeing some improvement. About 3.5 last year is down to about, we expect it to be at 2% at the end of 2019. So these are some of the things that we believe can be very positive for First Bank's earnings.
Okay, little time left. Let's quickly jump to UBA. Is the story there, their footprint across Africa?
Yeah, UBA in a way appears to be insulated, partially insulated from some of the measures we've seen recently from the CBN. The downward review of fees and commission, LDR, most of all these have implications for the Nigerian operations. But because of the other African footprints, they have a bit of a cushion there if they can continue to concentrate the strategies and plans in those other areas, and that's supportive of their businesses. So while other banks would really have 100% hits their performance in Nigeria. For EBA, maybe about 60%, which is the Nigerian contribution to overall earnings, will be affected.
All right, real quick. Only got a minute left. Real quick, GTB. What are we seeing there? What's their story?
Yes, so GTB, I mean, high ROE, cost measures have been very, very strong for the bank, and I think that's likely going to continue to support performance, although the downward review of fees and commission may impact them because GTB does not have as much cushion as other banks like Zenith. Trading income for the bank is not high, about 15%, unlike Zenith Bank that has about 40%. Okay. So that may really impact them. But then as you grow your volumes because of your retail footprint, then that would support fee income over time.
Jerry Nnebue of Cardinal Stone, research analyst. So much talk. We didn't even get to LDR and cash reserve ratio, but we'll have you back. Thank you so much for your insights on looking at the banking sector.